Hi, welcome to another episode of Vantage Point by DigiJanus. I am absolutely very excited because today's episode took me I think 8 months to get together. I've been running after Walter for such a long time. So Walter, welcome to the show. Thank you so much for being part of our journey.
Laksh, it's great to be here, and sorry it took a little while, but I'm really keen to spend some time talking about what I'm doing.
Yeah, absolutely. And I want to clarify that Walter did not take that long. It is just like the planning and everything. He's been very kind through the whole process. And, so Walter, we don't want to waste any time. We want to get right into, all the insights and your journey and how you have disrupted the insurance industry and what you're up to next. So,
Sure.
If you have seen this show, we try to ask the difficult questions first. We are a very unique show in that aspect. So the first question is, in 2014, you were the CEO of HSBC, right? Just before you left and started Singlife. So what was the thought process around, leaving, and why could you not do what you did with Singlife within HSBC?
Well, it is a big question. I mean, I've been in Singapore for almost 23 years, and I've always just loved building stuff. I'm an actuary by training, and I've been in the insurance industry for most of that time. And at my time when I was at HSBC, being the CEO there from 2010 to about 2014, I learned a lot of stuff. I was very privileged to be a part of the HSBC insurance business, but also having time on the executive of the bank and on the board of their asset management firm. So you see a lot of the components of how a financial services business can get put together. But I've always had this itch or this yearning to build something of my own, this idea that I can do something tangible. I spent parts of my career as a consultant, parts of my career as a reinsurance company, but where I'm most happy is when I'm playing with Lego in the sandbox and building cool stuff.
Right.
So it got to the point in time when, after having done a big career with HSBC, that I really wanted to have a chance to build something new. My father-in-law once said to me, if you're ever going to start something new on your own, you have to do it before you're 40, because after that you have too much to lose.
Yeah.
So we gave it a go and thought, well, what's the worst that can happen? If it doesn't work out, we can always just get a job again.
Yeah, absolutely. So very good advice from your father-in-law. I think he did not know you will start another one after 40. So I had something very similar from my father-in-law as well. So now you mentioned something, and see, insurance industry has been a little bit of laggard when you look at digital transformation. The speed of innovation in the financial industry is already slow, but for the insurance industry, it has been even slower. Why do you think that is?
Well, it's a complicated business, right? There is a lot of moving parts, and it is a very traditional business. It has been slow because it's just worked in a certain way for a very long time, and there are a lot of complexities around regulation and governance and systems and stuff, which makes it quite a time-consuming process, and it always has been.
Right. What do you think the insurance industry, within the boundaries of regulation and the constraints, could have done differently to move faster and to innovate faster?
Well, if you look at financial services, the biggest evolution has been in payments and payments-related things. You've had a lot of technology enhancements in that space over time. Banks have caught up a lot. Insurance companies are right at the very tail end of those transformations, but they are slowly getting better. Our view at the time was surely we can do a better job than the rest of the industry, given just how inefficient the insurance industry has been in the use of technology so far.
And this brings me to the next part of the discussion, that why did you start Singlife? You were already at HSBC, you are the CEO. You can make any kind of transformation happen like that you want, right? With you have the budgets, you have the people, you have the technology. Why start a new insurer?
Well, the simple answer is just to see if I could, and that's about as simple as it is. Well, because I've always wanted to be in control and own it, and I've always wanted to manage my own future and destiny and build something, right? And this gave me an opportunity to take the skills that I had accumulated over the career so far and apply them in a way that I thought was useful. I really thought that we had the ability to take a niche in the market that was different from the way the players were, which was in this idea of using technology and digitization of processes to create massive efficiency, simplicity of structure, so that we can actually pass that efficiency and that cost savings back to the customers, and just make insurance a much more pleasant thing to deal with than it's been in the past.
No, and absolutely. And I've been watching this Singlife journey. My Singapore journey started at a very similar time. So when you're looking for your first insurance in the country, you're looking at this very snazzy website. You can go in there, you can buy the insurance that you want to do, rather than talk to like 5 different agents who will tell you could die, this could happen, that could happen. The insurance selling process, right?
That's
and
right.
This was a very seamless experience. So it resonated with me. FYI, I am a customer, so
Great to have that.
Yeah, and so how did you start on redesigning insurance or digitally transforming insurance in the first step? Like, if you could walk us through that process,
Sure.
that would be great.
Well, the first step was to just shorten the process for application and sign up. And with that also means simplifying products, simplifying language, simplifying everything. There should be no reason why you can't just buy it. Like, if you can buy something on Amazon and pay and you've got it in 10 minutes, why can't you do that for financial services? So that was the ambition. But of course, not everybody likes to just buy things directly online. People do like to compare. People do like to get advice sometimes. But what we've realized was that while some people really want to buy it online, some people also want to get it from financial advisors. And we also wanted financial advisors to have the choice about whether they wanted to sell our product or somebody else's product and be benefited from that. So what we then did was we realized that even if a customer would want to directly come and buy from us, an advisor might also want to directly sell our products as well. So we made the processes equally easy for advisors to sell and for direct people to buy, all in the same simple way, the same simple price, the same simple mechanic. And it worked incredibly well. People and advisors all loved what we were doing, and the business grew well.
Yeah, absolutely. And let me ask you this. So there is this offering that you guys had, which became so popular, I think you had to cap it or something. So you were offering a 2.5% per annum account with access to a Singlife Card. So there are 3 things I want to ask you about it. One, what is the thought process behind launching something like that? How do you even get to that? 2, like, once you were there, what was the response, etc. And then why did you cap it? Like, those 3 things I would want you to walk us through that journey.
Sure. So the reality is that not everybody wakes up in the morning and says, yay, today's the day I'm going to go and buy some life insurance.
Yeah.
And the biggest challenge that insurance companies have had with their customers has always been, how do you create an engaging relationship? Most of the time we talk to customers when they haven't paid a premium, or when there's a claim, or there's something not so nice that's happened. So how can we create a regular, active engagement? Second point is, if insurance as a product is something that's quite a high value product, how do we funnel people towards that insurance decision? How do we make a relationship with customers much earlier on in their financial services journey? And the answer is very simply cash. If you can get close to a customer's cash, you can then get closer to his investment decisions, his longer term savings, his insurance needs, his health, and all these things if you can manage that cash. So we built this product and we called it the Singlife account, and it really was an insurance contract. You could put money in at any time, you could take money out any time, and we would give you a cash return, or call it a crediting rate on that.
Yeah.
And what we did was we said, instead of having to fill out a form to withdraw your money, you could just push a button and send it to your bank account. Yeah. Or what we did was we added on a Payment Services Act regulated debit card. So I could go and pay something at the 7-Eleven and actually withdraw money from my life insurance policy. So we were able to get a cash relationship with customers. It worked brilliantly. Of course, at the time, or even today, people are not getting great returns on their cash. So this cash offering did really, really well. Too well, in fact. I think we had 100,000 customers and $1 billion on the platform in about 7 months. It was super fast.
Yeah. Yeah, and so now a quick question there is, so I have done some research and there is, we were supposed to get connected before, but we did not. So there was this time you wanted to go after the ultra high net worth segment. And everything was set. How I know this is because we were supposed to meet and interview.
Yeah.
And then the whole merger happened. So what was the thought process about going through like on the ultra high net worth segment, because that is a very different segment, with very different needs. So what was the thought process?
When we started Singlife, the high net worth segment was absolutely central to what we were doing. We found that Singapore was a place of trust, and the high net worth individuals loved the fact that Singapore as a domicile for their wealth was available. We did build the high net worth products, but we did that in 2017, 2018, and we did very, very well on that. But actually what happened in 2018, 2019, interest rates fell so low that I made a call to say that I did not believe that those products were creating value to the people that were buying them. I thought they were oversold, and I thought that our competition was actually being disingenuous about the projections on those policies. And all of this is all now come back, because you can't project a 4-5% credit rate return when you're only earning 2-3% on the product.
Absolutely.
So at the time we said, look, that we don't want to be disingenuous, we don't want to promise something that we can't actually deliver on. So we actually we slowed down the high net worth business and we left that to the others, because we didn't want to play in that space, and we focused very much harder on the retail business.
Absolutely. Thank you for letting me know. Now I know I was not rejected. It was the market dynamics that resulted in a different direction. And this is a very amazing conversation, Walter. So one thing, this was going so well. Where did the Aviva merger,
Well, as you said, it was going really well, and we did have to slow it down. And the reason you had to slow it down is because we grew so fast. Insurance businesses require capital. So same as a bank, every company that has a financial services offering has to make sure that it can deliver on the promises that it offers. So if we were doing this 2.5% product, if we took customers' money and invested it, we would have to hold roughly 7 cents in the dollar as capital. So as the business grew, we'd have to hold more and more capital. So at $1 billion of assets on the platform, you'd have to put about 70 million there. So which would mean that our business had to continue to raise capital as we grew. And we did, we raised quite a lot of capital. But the opportunity came when Aviva was looking for a change in their business or an exit. And we then had a good discussion with the Aviva people to say, and my view at the time was, the Aviva business had a good, solid, stable profit base, which could then provide the capital that I needed to continue to grow the Singlife account and these kinds of things. Aviva had great, deep quality products. Aviva had 3,000 plus advisors at their disposal to talk about products. And Aviva had 1.5 million customers, which we could then give a much bigger, broader financial services offering to, by taking not just the Singlife kind of engagement products, but the Aviva deeper protection products, and bring all this together to enhance the value of every customer in the combined Singlife group. And that's what we were after when we brought the two companies together.
No, I'll tell you, and this is coming from a personal experience. When you try to marry two companies whose DNA is a little different, it is a big challenge. Now Aviva is this historical insurer with great products and a great business, as you mentioned, and Singlife is this new sexy insurer, technology first, going out there and breaking the norms. Walk us through the marriage of these two, walk us through the first year, the ups, the downs, and the surprises of going for something like this.
Well, look, it was a big challenge for us to bring this together, but I think the outcome was that we built something which tried as best it could to take the best of both worlds and bring them together. Now, that's not an easy thing to do ever. Bigger companies do have, they move slower. Bigger companies move slower, and so that was very frustrating. Just the Singlife guys bringing their bits in, and it was a bit annoying to the Aviva guys because they were being pressured harder. But over that course of time, everybody comes together, everybody gets around the strategy of what we're trying to do and move it forward. But that's, as the end result, we're a good, big, strong company.
Like, pardon me, I'm going to ask you a tricky question. If this worked so well, why are you not the CEO right now?
Well, I mean, at the time, when we did the transaction, I saw how could I take the best of Aviva and bring it under the Singlife rocket ship.
Yeah.
However, there were others in the group that thought, how do we take the best of Singlife and make the Aviva battleship go even faster?
Yeah.
And Aviva being the bigger enterprise, we took the view that actually the best person for the job was the current CEO of Aviva at the time, and then I was then going to help from the board's level to let him go through. And we thought that was the best outcome at the time. In hindsight, would I have loved to be the group CEO? Absolutely, and I was very disappointed when I wasn't. But sometimes you don't get what you want, but you get what you need.
Yes.
And I gave me the opportunity to do some new things.
Yeah.
And I'm thrilled about where I am in the world right now.
Yeah. I have recorded 20 episodes, and this has been the most honest answer that anybody has given on this platform.
True. Yeah.
Yeah. So now that we go from the Singlife Aviva journey to what's next for you, right? So now you are in, you were the chairman of the combined entity, and you are thinking about something new. So walk us through the process. Like, how do you think about a new venture after you have just taken such a successful exit?
Yeah, so it's not about exit. It's more about what are you going to do with your time all day long. You people like me, we just want to do stuff. You want to be gainfully engaged and find something that you like to do. And I can't sit still, and I like playing with stuff. And I had an idea around chocolate finance as a new type of venture, and I thought, well, I've got two choices. I can semi-retire, or I can go and have fun building businesses and helping people, get better value from their savings. That's what I'm trying to do.
Absolutely. Now, we've talked about a lot of your past experiences. What we do want to talk about now is what you're doing next, and chocolate finance. It is very exciting. We've had some chats about it. Really excited to see that. So you built Singlife, you have merged it with a bigger entity that is doing really well. Why chocolate finance?
Look, if you're anybody like me, you've got two buckets of money. You've got a bit of money which you spend your day-to-day stuff on, and you've got a bunch of cash which is sitting in a bank which is not doing very much at all. And why do I have it there? Well, I'm waiting to invest it in something, but sometimes I miss the opportunity to invest, or I don't know what to invest it in, or I'm waiting for, I think I've missed it if prices go up, and I'm worried about prices going down, and I've just got cash which I know I need to do something with, but I just don't. But the reality is that I never will, because I like having it in cash. It makes me feel cool having it in cash. It's accessible, and it's kind of there when I need it.
Walter, absolutely very excited about your new venture. We have had some conversations. I feel very, very excited about what it's bringing. I want to hear your version of what the clients can expect from it. What would their journey look like? And, why will they choose chocolate finance?
Sure. So chocolate finance is designed to do one thing exceptionally well, and that is to give you a better return on your cash. That means you have to have not just a product that gives you returns, but you have to have an experience around that which makes you feel good, makes it feel that you're in safe hands, make the process as simple and easy as possible. So what we do, and as I've done my whole life, is to digitize and make things more efficient, to find a better way to deliver all this stuff. So as a chocolate customer, no matter where you are in the world, you can open a chocolate account, which is actually an account which gives you access to the chocolate funds,
Yep.
which delivers the returns that we're giving you.
Yeah.
And that's done on a phone app. We do everything on mobile because we believe that that's the simplest and easiest way to do things. We use web for information and information sharing, but the execution is all around an app. So your digital onboarding is painless in a couple of seconds, especially if you're using SingPass in Singapore, but your onboarding is really, really, really neat. And you can basically open a chocolate account in a couple of minutes and you're good to go.
Yeah, absolutely.
Simple as that.
Thank you so much for that, Walter. And we have had so many conversations, and even at times when the interest rates were like really very, very low, my bank account today gives me 0.05%. How are you generating these high yielding returns, and what is the risk associated with this? How safe should a customer feel when they're putting this money with you?
Sure. So what we do with customers' money is we actually aggregate it and use it to purchase short-term fixed income investment grade bonds, which are global in nature, multi-currency and hedged. The idea around that is we know that because there's this component of money which is slightly longer term, we can actually invest for a higher duration in order to give you a slightly better return, which is different from a traditional cash or money market fund. We're actually taking a little bit more duration. And what we do is because we keep the amounts relatively small, we can make sure that the volatility of that fund is very, very low. And then we will fund the liquidity as is required so that you can make sure that your cash is available to you anytime you need it anywhere in the world.
Yeah.
That's how we do it.
So, and you are a pretty smart guy, you build so many things and, but why are the banks not doing what you are doing?
Well, banks have a lot of other things to worry about. When you, as a bank, you take a customer's money as a deposit, and you're not as able to deploy that money as freely as you might like. Obviously, you've got credits and loans and things that you can make. You can do a little bit of bank management, overnights and things which you can do on that bank. But it's your ability to create significant superior returns is actually quite low. As an asset management company, Chocolate doesn't have the same restrictions. So we can be a little bit more aggressive about the returns that you get without actually taking a lot of extra risk.
Yeah, and is there an aspect that you are much more nimble and agile that is bringing these savings or bringing an extra interest component that can be passed on to the customers?
Well, we work with some of the most prestigious bond managers in the world to run some of our business So when we invest Chocolate customers' money for the benefit of getting better returns, we use some of the best asset managers in the world.
Yeah.
Dimensional Fund Advisors is a partner of ours. So they have produced some of the best returns available, and we've structured the mechanics behind the delivery of the Chocolate Finance product with the best of the best in the world to work with us to generate the returns that we need to.
Yeah, and Walter, like knowing you during these conversations, etc., one thing I feel is that once you're doing something, you're always thinking about what's next. So how do you see Chocolate Finance evolving over the next 5 years?
Well, we'll have to see. I think if we can get known for a very cool way to manage your cash, if we can be a Revolut on steroids, if we could be positioned in that way, that's my ambition. Of course, around cash, there is all sorts of other things, which would be remittances and FX and all that other things that goes with it. But actually, over the longer term, we'll see how it evolves. Time will tell. We've seen in the world things like Robinhood doing fractionalized share trading. We've also seen Robinhood not do very well in some ways. We've seen some robo-advisors appear. We've also seen robo-advisors that are not delivering on the promises that they were making either.
Yeah.
So we'll have to see as we go. But if I can deliver a great return on cash, stand behind that and make people happy about that, job done.
Yeah, no, and you are also a little bit of an exception because everybody talks about a funding winter of sorts that is going on here. But I do see that you've raised 19 million from Sequoia and some of the others. So how do you raise 19 million in an environment where nobody wants to take a bet on anything which is a little risky?
Well, I think a business like ours, with the potential that it has to be providing a truly meaningful product, is going to require a lot of capital. And in the past, through the businesses that I've done previously, we raised billions of money to support that business and grow through its transactions. So what I was looking for in shareholders were willing and able and very deep-pocketed shareholders who are going to help us to keep growing the business as it needs. And I've been very, very fortunate in the investors that have come on board who are all like-minded about the vision of what we're trying to achieve. It's tough out there at the moment in the market, but I think the fact that we got such great response from the capital markets in building this business suggests that people are really believe in what we're trying to build, and that it's actually going to be massively successful because it's going to do what we say it does, give you a better return on your cash, and who doesn't want that?
Yeah, I want that. Absolutely. Now, let me ask you a few questions, and like it is very rare we have entrepreneurs like you on the show, so I want to ask you a few questions. What do you think differentiates you from all the other entrepreneurs out there? Why are you so successful?
I don't know. It's not about success. It's just about do cool stuff and have fun doing it and be passionate about what you're doing. And if you really like it and you're good at it, then you can't fail, because if you build something cool that people actually want, they'll buy it. Then it's about figuring out, okay, well, how do you market it and put it out there? How do you make people aware of what it is that you're selling? So in the Singlife days, it was all about building brand. Chocolate is going to have a big brand presence as well, just to create awareness. I do see there are some guys that build really good stuff, but then they're too worried about your product and not about how you're going to make people aware that it exists. And if you can't think through how do you scale, you really struggle.
Okay, and I agree with you. You have to be out there for people to know you built something. Then only you have a chance of failing or succeeding, etc. Even if you're not even in the race, how are you going to win, right? So if you had the chance to redo something, like let's say we built a time machine, you would go back and restart. What are 2 or 3 things you would do differently?
What are the 2 things I would do differently?
You can tell us 5 also. We have enough time to listen to them.
Like my wife says I'm a bit like a goldfish because I can't really remember the bad things that happen, and that's because I love fixing stuff so much that when a problem comes, the fact that I've been able to address the problem is it's like a drug, and that endorphin that I get and the sense of achievement that I get from fixing something is so good that the problem is actually an opportunity every single time it comes up because of the benefit of fixing it. So if you're asking me what are the mistakes I've made, I can't really say because I fixed them.
Yeah, absolutely.
And I loved it all the way through, yeah.
No, and thank you so much for that answer. And that also tells you, as entrepreneurs, we have to be hopelessly positive. You have to look at the positives, the learnings, and you have to keep moving forward, right?
That's right. I mean, people do say the entrepreneurs do need to be eternal optimists, but they have to be, there has to be sometimes a little bit of experience to know enough detail about what it is that you're building or doing, or the market that you're playing in, and the factors that are going to affect you. Because otherwise, if you're overly optimistic, you might actually miss out on the curveballs that get thrown at you because you just don't know, or you're not willing to acknowledge that sometimes things aren't as easy as
absolutely
you'd like them to be.
So So thank you so much for that. And so I have, before we let you go, I have two questions for you. One, what would be your advice to all those people who are trying entrepreneurship in a different and difficult climate like today? So what would be your advice to them?
Well, the first one is be very, very cost conscious, because raising money is hard, and you need whatever capital that you have to last you as long as you possibly can. You do need to do things with as few people as you possibly can, and keep things super lean, because growing too fast, too quickly can sometimes overextend you. Be passionate, tell your story to anybody and everybody that'll listen to you. If your friends won't buy your product, then your customers or nobody else will. So you got to be relevant to pretty much everybody to get your product out there. Be passionate, always tell the truth. Never. You reap what you sow. So be honest and genuine, I guess, in what you're trying to do, and customers appreciate that, investors appreciate that, and I don't know, just be true to yourself, and good things will come.
Yeah, absolutely. And just out of curiosity, with the era of cheap money being over, do you see entrepreneurship will change? Yes, well, differently. I think that with cheap money being over, I think I think there'll be a shift in what investors are investing in. I think the old days of, throw money to acquire squillions of customers that you can monetize later, those days are gone. So I think from an entrepreneurial perspective, those businesses that can generate revenue as fast as they can are much more likely to get capital and grow. And there will always be money going behind those businesses. So, the private equity firms they're not all gone away, right? So the money is still there. It's just being deployed in a different way. We're going to see different sectors coming to the market for exposure. So things like fintech will be far less on the radar, or has been far less on the radar, and things that are more positive now would be your healthcares, your pharmaceuticals, the production of real goods, trade related stuff. Those kinds of businesses creating more tangible product with real marketplaces, I think, is what's going to attract more capital in the future. Yeah, and before you go, the last question, I promise. If there is one thing that you could change in the financial industry today, pick up any segment that you want, what would that be? I think what I really want to do is to give customers a better value experience of financial services. I think that most of the financial services companies take a lot of margin, and there's quite a high cost of things. So my view is, and what Chocolate will do, is we won't make any money unless our customers make money first. So management fees only happen after customers have been rewarded with the returns that we're targeting. And I think that's an important thing to put customers first. If that's the thing I'm planning on changing. Absolutely, and I'll try to be the first customer to sign up for this once it is available. I'm going to be glad to have you. Absolutely, and thank you so much for joining us. This has been a pleasure. It was absolutely worth the wait that we have, and all the planning. So thank you so much. Wishing you the best for Chocolate Finance, and really excited about the things you're bringing to the market. No, brilliant. Great to be here. Thanks for inviting me, Laksh. Thank you.